So we know that book value per share is assets minus liabilities divided by shares outstanding. In this instance, you've indicated before in some prior videos that we have that in some industries, you care more about book value than other industries. However, if book value is just simply assets minus liabilities, or the assets that you as an owner are entitled to by owning shares in this business, why is it that then you make these discrepancies, you make these differences between caring about book value in particular industries or particular companies, and then not caring about book value in other industries or companies? Am I making sense with what I'm saying?
Yeah. Well, it just depends on the type of business we're looking at. So asset light businesses, I'm not going to care about book value. Asset intensive businesses, I'm going to care about book value. I'll give a brief example. For example, banks, insurance companies are asset heavy businesses. So you look at their balance sheets, they have a ton of debt instruments on the balance sheet. So a lot of assets. So you want to be paying closer attention to the book value per share as a flagpole for value. When you look at something that's like a software business, you're not going to put as much weighting on the book value simply because it's an asset light business. So there's not really a way for you to properly value, for example, the brand of something. Like, for example, you'd say Coca-Cola. Well, Coca-Cola's brand is immeasurably valuable. So how do you put a value to that? But you can put value to their assets, like their distribution channels, any trucks they have, stuff like that, because that's something that they could feasibly sell, and then anything extra is icing on top. So you also want to be careful as to what you're including in that book value. Be careful about your inventories, right? So inventory values with, I think a good example is technology, like for example, TVs. So you have a year-old TV. As the new TVs come out, the older TVs aren't going to be valued the same. So you have to write those probably down. So you want to be careful not to just take the value of inventory at face value. You may want to be a little more conservative. At the most conservative you can be is just eliminate the value of inventories. And if you still get a decent book value, if you care about that for that business, then you should be okay, because that's a good margin of safety. And then if they're managed to sell any of the inventory at whatever cost, you'll be happy because you were happy with a more conservative book value. I hope that kind of makes sense here. But with this business, I wouldn't care too much about the book value. It's not as asset intensive as others. It is going to be inventory heavy, but not so much anymore, because they're moving over to the dropship model, which means they're not going to be carrying a lot of inventory on hand. So it's going to be even less of an indicator of book value. But that being said, when it's a company that I don't care about book value too much and I can get it at book value, that's pretty much indicative of something that is extremely cheap. Now, the fundamentals may be terrible, and that may be why it's cheap. So you don't want to just say, oh, low book value, therefore buy. That's what people think value investing is. I go with Warren Buffett's description of value investing, and that value investing is just investing. So if you're taking a growth company and you're buying it when it's undervalued relative to its future growth, that's value investing. Everything is value investing. There's no other form of investing. People like to pigeonhole value
Would you
investing.
actually kind of elaborate on that more? Everything is value investing. There's no other form of investing. Would you kind of actually elaborate on that more? And then we can kind of cover some of the activity ratios with this business before we wrap up the show here today.
Yeah. So in the finance world, you may have, if you watch financial TV like CNBC or Reuters or anything like that, or even your finance textbooks, they'll segregate the different forms of investing, such as value investing, growth investing. I will say dividend investing actually is a legitimate category of investing, and then non-dividend investing. I think those are the true subcategories of value investing, but I think all investing is value investing, because value is relative, right? So if something is expensive on a PE basis, like whatever that means, expensive, right? Because people say the average of the market is 15 over long periods of time. So anything above 15 is expensive. Well, Peter Lynch put it beautifully that, well, in the 1980s, he was talking about how that's not necessarily the case, because if it's For example, a PE of 40, but it's growing at 40+%, it's actually relatively cheap. He created the PEG ratio, or he utilized the PEG ratio a lot. And it stemmed from that time period. So it's relative. It's still a value. So for example, something is a PE of 40, and I tell you it's going to grow 50% plus every year for the next 10 years. Let's say we had that scenario before us and somehow you knew that, that's a value play. Or that's not a value, but that is a value, right? And so all investing is value investing. If you're buying a stock and you think it's undervalued for whatever future performance it is, you're just investing, and that is value investing. Now I said that the only two valid categories I would say is dividend investing and non-dividend investing, right? So some investors prefer dividends, some investors prefer non-dividends for whatever reason. Some say for tax reasons, but in essence, those are two valid preferences that investors can have. And then there's the investors that don't care, right? They don't care if it's dividends, non-dividends, they don't care.
So now kind of touching on this as well, unless you were about to go here, because I see a common trend on YouTube where a lot of people talk about, oh, I'm a growth investor. I invest in growth companies. If I'm understanding what you're saying, even the concept of wanting to invest in growth companies is a derivative of value investing. Whereas most people tend to see value investing as, investing into blue chip companies, et cetera, so forth.
No. Yeah.
What you're saying, all of it's value investing. The only legitimate forms of sub-investing is dividend investing and then non-dividend investing.
If you're buying a stock because you think it's undervalued, you're value investing.